Welcome, dear traders. Last week, US stocks retreated even though there were no fundamental reasons. Investors were expecting the Fed to shift to a softer stance. However, there were no prerequisites for it. Hence, they had to face the brutal truth a bit later when FOMC policymakers delivered their hawkish speeches. They once again confirmed a strong commitment to further monetary policy. It's too early for the Fed to take a pause in the aggressive tightening cycle, as inflation has not perked yet. It turned out to be more persistent than expected. This is a solid argument for the regulator to hike the key rate to restrictive levels that could slow economic expansion. Given recent comments, the Fed is going to raise rates at the start of the next year, even if there are signs of a slowing economic growth. Wall Street plunged deeper into negative territory. Stocks ended last week in the red, returning to their two-year lows, and this week has kicked off with the losses as well. The upcoming sessions are likely to be highly volatile as investors are looking forward to the Consumer Price Index. Analysts predict a downbeat report. High energy prices may increase inflationary pressure. Watch our video review till the end and find out the latest market news. Let's start. Apart from inflation data, there will be plenty of other economic reports this week. The retail sales report for September is due. Several Fed policymakers are scheduled to make speeches. What's more, the FOMC meeting minutes are on tap. Investors will receive many clues about the future economic prospects and the Fed's monetary policy, so that they can adjust their trading strategies. Another crucial event is the start of the earnings season on Wall Street. Speculators are now more confident that the Fed will stick to monetary tightening. They are pricing in a 75 key rate hike at the next meeting. The non-farm payrolls report published last Friday signaled such a possibility. The non-farm payrolls report has again indicated a tight labor market. Nevertheless, the figures turned out to be moderately positive. The US economy added 263,000 new jobs in September, topping the forecast reading of 250,000. However, the reading was smaller compared to the last months. In August, the economy added 315,000 new jobs. And this year, monthly job growth has averaged 420,000 compared with the 562,000 per month in 2021. The labor force participation rate was little changed at 62.3% in September. Average hourly earnings for all employees rose by 5% in annual terms compared with the 5.2% in August and the forecast reading of 5.1%. Notably, this indicator reflects inflationary pressure too. Following the non-farm payrolls report, all 3 US benchmark indexes declined sharply last Friday. They began the new week on a pessimistic note despite a drop in the volume of short positions. However, trading floors in the US were closed on a Monday on the occasion of Columbus Day, yet speculators were able to trade shares included in the NASDAQ index. The US bond market was closed. The Dow Jones lost more than 600 points in a highly volatile Friday session. The weekly changes were moderate amid a rebound at the start of last week. An upward reversal was quite significant. For instance, the S&P 500 gained 6% in 2 days after logging one of the worst performers in September. In the first months of autumn, the index decreased by 9.3%. The US indexes managed to recover amid the PMI manufacturing index and the labor market report. They reinforced expectations for a slowdown in the pace of a monetary tightening. However, similar short-term rallies have already happened in the equity market in recent months. Shortly after stocks rolled back to new lows, the Fed is adamant about further rate hikes. It will hardly change its stance in the near future. For this reason, many investors were cautious after a rebound took place. This year has been tough for speculators. They hope that the recent signs of unstable economic growth will sooner or later prompt the Fed and other world central banks to slow down aggressive tightening in their fight against inflation. Higher rates constantly trigger sharp swings in stocks and bonds. Now traders are skeptical about a possible long-term rise in stocks and bonds. Reputable think tanks such as UBS tend to believe that stocks usually rebound when they are oversold. The recent short-term recovery may have been facilitated by the auctions of bearish traders who closed their positions after the September fall. It's still hard to say whether the stock market has bottomed out. Bank of America stressed it sees no signs of a capitulation on Wall Street. It means that the stock market may reach the bottom in the near future. The volatility index, also known as the Wall Street Fear Gauge, has not approached levels that could indicate that stocks dipped below the lows of previous sell-offs. Currently, the bearish sentiment prevails. This is the longest bearish cycle since 2007 and 2009. On average, the bear market has lasted for 14 months over the past 8 decades. However, bear markets with various durations have occurred during this period as well. For example, in 2020, at the height of the pandemic, pessimistic sentiment lasted only 1 month. In 2000 and 2002, sellers dominated the stock market for more than 2 years. Another confirmation that the recent upward reversal was just a temporary correction is the dynamic of the S&P 500. As we have already mentioned, it dropped by 9.3% in September. Every time, excluding 2008, when its losses exceeded 7% in September, there was a rebound in October. After a short-term recovery last Monday, the S&P 500 index sank by more than 3% in just one trading session on Friday. This is why traders are casting doubt on a steady recovery, anticipating a further decline. There are reasons for this. To start with, the central banks worldwide keep rising key rates. The Fed is very unlikely to change its hawkish stance, even if there are some negative reports. Therefore, there are odds of another sharp rate increase, and the November meeting are rather high. Besides, the S&P 500 is expected to report earnings growth of 3.2% for the third quarter. If so, this will be the smallest gain in 2 years. Analysts have made their predictions on the S&P 500 taking into account a persistent bear market. However, short-lived recovery is possible in the first half of the fourth quarter given the strong recent bullish momentum. Yet a downward breakout is likely to occur eventually. The target level is located at 3,595 points. If the index stumbles below this level, it could reach the range of 3,235 and 3,195 points. On Monday, risk sentiment decreased considerably amid geopolitical tensions. The Russia-Ukraine conflict has escalated once again. Missile strikes hit the Ukrainian capital of Kiev and several other regions following the blast on the Crimean Bridge. On a Monday, the S&P 500 tried to consolidate above the support level of 3,600 points. However, it may dip below 3,400 points. The heavy-tech NASDAQ 100 had a similar dynamic. It fell by almost 3.8% last Friday, ending the week in the red. The earnings season for the third quarter starts this week on October 14. In the coming days, the largest U.S. corporations, including JPMorgan, Wells Fargo, Morgan Stanley, and Citi, are going to reveal their quarterly results. The U.S. stock indexes may notch sharp swings following the release of earnings reports. Bulls will definitely assert strength if the reports turned out to be better than predicted. Estimates for the third and the fourth quarters will downgraded markedly. Hence, investors lowered their expectations too. To some extent, this is the main reason why stocks have been unable to climb during the third quarter. Apart from that, uncertainty over the Fed's future moves on the monetary policy also pushed the stocks down. As for the downbeat profit outlooks, there might be silver lining in them. It will be easier for companies to surprise investors with the higher-than-expected results. However, it's better not to pin high hopes for positive quarterly reports, as the results of some companies will definitely be disappointing. For example, the earnings reports of such companies as Nike and Micron, published in late September, were extremely negative. It led to a drastic decline in the shares. Pessimistic forecast also exerted pressure on market sentiment. There are companies whose revenue outlooks have not changed significantly. This is why traders should be alert, as there could be a sharp market reaction if the figures undershoot expectations. JPMorgan is scheduled to reveal its earnings report on October 14, and the profit outlook has not changed dramatically. It was downgraded after the results for the second quarter. However, it has hardly changed since then. JPMorgan shares tumbled in August. They are now almost at the July levels, having recouped the early losses. Therefore, the revenue outlook for JPMorgan and many other companies have not been slashed. The earnings season could be better despite low market expectations and the bearish trend. Bulls may have a chance to regain the upper hand, so the dynamic on Wall Street is likely to be the same as it was in July and August. Besides, traders are likely to pay more attention to the fourth quarter revenue outlooks rather than the third quarter earnings reports. Tesla shares will be in the spotlight after the company smashed its monthly sales record in China. It seems that the company managed to get back on a track rather quickly after the closure of a factory in Shanghai due to the coronavirus outbreak in China. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. See you soon.